Can we talk about maybe the role of life insurance and the role of annuities in this sort of blend in a normal balanced household?
Yep.
What that kind of looks like? What is the role of life insurance and annuities specifically within this plan?
I'm going to talk about briefly, three different ways that cash value life insurance can materially exert a positive impact on your financial plan. Number one, and Tom Hegna frequently says this, I know you've had Tom Hegna on before. He says, if you reach into your portfolio, remove the bonds, replace it with cash value life insurance, you will increase your return, you'll lower your risk, you'll lower the standard deviation of your entire portfolio, and you'll experience a better outcome over time. It's just the way that insurance companies manage risk. They can give you, and then the economies of scale that they have as well, they can give you a higher return for less risk. Because in most, these fixed products, they're guaranteeing that you won't lose money. So it's as a bond replacement. People say all the time, particularly when it comes to IUL or what have you, they'll say, IULs claim to be a stock market replacement. I say, no, I'm not claiming that. I'm claiming that it could maybe get you 5 to 7% net of fees over time. That's not a stock market replacement, but it's an excellent bond alternative. I think whole life could be an excellent bond alternative. So that's the first context. The second context is what I mentioned a little bit previously, is that people get heartburn when they think about paying for long-term care in the traditional ways. And I think we need to be talking about long-term care a bit more during our meetings. And this is a brief conversation I have with my clients. I'll say, Mr. Jones, you know I love you, right? And he'll say, yeah, Dave, I know you love me. And I'll say, I do love you, but you're better off dying than needing long-term care. And he'll say, well, be taken aback. He'll say, Dave, what do you mean? And I'll say, well, at least if you died, Mrs. Jones here is beneficiary on all of your accounts. And while we would miss you terribly, life for her is going to carry along relatively unchanged. However, if you didn't die, if you almost died and end up needing long-term care, all the money she was planning on living on now gets earmarked for the long-term care facility. And she gets to keep one house, one car, a minimum monthly maintenance needs allowance of about $2,500 a month, and depending on the state, about $130,000 of cash. So what was shaping up to be a perfectly rosy retirement for Mrs. Jones turns into basic bare bones subsistence type living. And of course, the converse is true if Mrs. Jones ends up needing long-term care. So people aren't opposed to having long-term care insurance. They're just opposed to paying for it. And what's great about cash value life insurance, particularly if you have a long-term care rider, chronic illness rider, is if you end up paying into this over time and end up needing long-term care, you no longer feed yourself, bathe yourself, transfer yourself, what have you, find one doctor to write one letter to that effect, they will start advancing you your death benefit. They'll give you your death benefit in advance of your death for the purpose of paying for long-term care. So, and like I said, if you die peaceful in your sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit. The last context in which I think cash value life insurance can really extend the life of your investments is when it comes to sustainable withdrawals in retirement. Now, we've all heard of the 4% rule, right? 4% rule says that's the maximum sustainable withdrawal rate in retirement. So if you have $1 million, you can take 4% that first year, you can take 4% plus inflation the next year, so on and so forth, and have a reasonably high expectation of never running out of money. The problem is that's a pretty expensive way of going about mitigating longevity risk, or the risk that you'll run out of money before you run out of life. Like I said, if you got $1 million, if you want to live on $80,000 per year, you got to save $2 million by day one of retirement. That may be out of reach for a lot of people. Dave Ramsey says if you tell people that, you steal their hope, right? So there's something called what I call, I actually got a book right here. It's called The Volatility Shield, in which I describe how cash value life insurance can be used to sort of vanquish the 4% rule from your life. And it works in the following way. If you can accumulate at least 3 years worth of living expenses in your cash value life insurance by day one of retirement, and then in the year following a down year in the market, you withdraw money to pay for your living expenses from your cash value life insurance instead of your stock market portfolio, that gives your stock market portfolio a chance to recover before you take further distributions. And that act alone can increase your sustainable withdrawal rate on your stock market assets to as high as 8%. And Ernst & Young recently came out with a study that bears all of this out. where they talk about how when you utilize cash value life insurance, annuities, and traditional investing all together, sort of as a three-legged stool, that actually yields the highest income than any other alternative. And so cash value life insurance, in contrast to what we're hearing from all the financial gurus out there, Susie Orman, Dave Ramsey, Clark Howard, Ramit Sethi, so on and so forth, it can increase the likelihood that you're going to wring the most efficiency from your retirement savings.
I was not aware there was an actual study out there that showed that. My philosophy for all these years, I absolutely love what you're saying. And just for the record, everybody watching who knows me, I did not invite him on knowing he actually was going to say that, because again, that's been my philosophy, is to build up. My rule of thumb was sort of 4 years worth. I mean, I've seen two as a rule of thumb. Dalbar put out a study. I think it was 2 years ago. Their quantitative investor, their behavioral study they do once a year. They actually labeled that. They gave that strategy like the prudent asset allocation, where not just some sort of rule of thumb, but per individual. Again, in our case, the ability for us to use our Money Guide Pro to see how much sort of defined benefit income they might have up top, how much they want, and therefore what's the gap? How much do they need to subtract from their portfolio? Then keeping, in my case, I recommend 4 years. Dalbar said 5. You're saying 3. So I think everybody on this call
three to five. 3 to 5 is the gold standard.
Yeah, get 3 to 5. And again, and kind of an iron, at least for me, ironclad fundamental of being a successful long-term investor is to not sell things when they're down. And when you're accumulating, that's not that hard. It's not that hard to meet with our customers and encourage them to keep consistently buying consistently, and which means you'll be buying on the dips that happen every single year. When you're in the withdrawal phase, that's a lot harder because you got to buy groceries. You got to pay for things. So again, being able to dip into those cash reserves wherever they are, whether it's fixed annuities, permanent life insurance, those are more efficient than, say, a typical savings account, but having them somewhere, allowing you to never turn temporary volatility into a permanent loss. I did not realize, though, that could allow you to successfully raise your withdrawal rate up as high as 8%. So I had not seen that anywhere. I might have to figure out what that study is and get that from you on the side and put it out there somewhere.
I also have when I wrote this book, I actually commissioned an Excel expert to create a Monte Carlo simulator that shows how high your withdrawal rate can go with what success rate. So it's 8%. 95% likelihood your money will not run out of money prior to life expectancy.
Okay, no, perfect. And I can see a couple questions in the chat. So one of which is, well, if you route money to sort of the conservative, again, and also, David, on this call, I jokingly will say, but I'm dead serious, but I say it in a joking manner, friends don't let friends buy bonds. So I love equities and I love things that have guaranteed principal, that with the ability to participate in a rising interest rate environment rather than get crushed by it. Things like cash value life insurance, annuities, even CDs, savings accounts, just basic things instead of bonds. So music to my ears, what you're saying about, hey, bond alternatives. And I guess to the audience, when you have, as a reminder, several years worth of your portfolio in something that is earning a lower yield, whether that's annuities, net of expenses, or a fixed annuity, cash value life insurance, understanding what the real rate of return is, when you combine, let's say, 20% of a person's portfolio in that category with 80% in equities, you get a blended return of, let's just call it 7% in this equation. That's how you start to build these portfolios. If you're illustrating 7% is what the customer needs to be successful in Money Guide Pro, then you reverse engineer into how the asset allocation model of how much in reserves, how much in equities to combine to target that rate of return. David, I'm saying that for the audience, is this IUL product, David, if you don't mind touching on that for a second. Is there anything that in your materials
So let's say you're trying to accumulate 3 to 5 years worth of living expenses in your cash value life insurance by day one of retirement. How are you going to do that? Well, you can either put a ton of money into it and hope to get there, or you can put less money in, but get a more robust rate of return. And like I've said, the IUL is not a stock market replacement, but it is going to give you more productive returns typically than a whole life policy or a UL policy. And most actuaries I talk to say you can probably expect 1.5% to 2% greater rate of returns on an IUL than you would a whole life policy over time. So if you're trying to accumulate money, if you're taking money that would have otherwise been earmarked for your Roth 401k or Roth IRA, and you're earmarking it towards a life insurance policy that has 2% rate of return, well, there's going to be an opportunity cost because it's no longer growing in your stock portfolio. And if you're trying to build 3 to 5 years worth of living expenses in your cash value life insurance, it's going to take you forever to get there, or you're just going to have to put a ton of money in. So if you can get 5 to 7% net of fees over time, it's just you're going to get there much faster, right? It's going to be a lot easier to accumulate 3 to 5 years worth of living expenses versus, a whole life policy or a UL policy. Folks, my upcoming book, The Guru Gap, How America's Financial Gurus Are Leading You Astray and How to Get Back on Track, is now available for pre-order on Amazon. Take the opportunity to order your copy today. Also, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.